There is a common misconception that many traders share in the options trading space, and it is the idea that selling options is inherently more profitable than buying options. Now, I was just like many of you all. I was researching how to trade options, I was learning about all the technical aspects, every single thing about options, and I was reading different articles, watching different YouTube videos, seeing different people's opinions, and I kept hearing the same thing over and over again. If you're not selling options, then you're going to be losing money. Or if you're not selling options, then you're stupid not to do that. And me being me, I always like to question what I hear on the internet, regardless of what it is. And of course, I wanted to question and research this as much as possible because I thought that there's no way that there's an inherently profitable strategy available in trading. And of course, I ended up being right. I texted my friend who was a former quant options trader at a major institutional bank, and he helped lead me towards a true conclusion that I now have today, which I will be sharing in this video. But before I get into the video, make sure to like and subscribe if you'd like to see more content like this. Also, make sure to join my Discord group down in the description down below if you would like to join our amazing community of like-minded traders. Finally, the one thing that I really want to try to add to every single one of my videos, at least when it relates to the video, is a book recommendation. And these are books that I'm actually reading right now, and they directly relate to what I'm going to be talking about today. So I really thought it was a perfect match. And these two books are Fooled by Randomness and The Black Swan, which are both written by the same person. And this is a part of a larger series, and it talks about events and randomness, uncertain events that may occur in the future. And this is great for finance, investing, business, pretty much anything in life. They're super interesting reads, and I guarantee if you like what you hear in this video today, you will definitely enjoy reading these books. But without further ado, let's get right into the video. The thing I want to start off with is the fact that on every trade, there is always someone on the other side of your position. So if you're selling options, which you think is inherently more profitable than buying options, then there's always someone on the other side who's buying that option from you who is just as much trying to profit as you are. And obviously people are not stupid. If people were stupid, so for example, if selling options were truly more profitable than buying options, then what would happen is over time, people would be selling options to an extent where it would no longer become profitable. And this is just how the market operates. Over time, if there truly is something that is more profitable or a better strategy that is commonly known, then that specific strategy will become less and less profitable over time as more and more people start doing it. And this is the efficient market hypothesis. However, that aside, I still want to go into the technical reasons as to why options selling is not inherently better than options buying. And this is what I think is much more interesting than the obvious reason of efficient market hypothesis. Now, the more technical reason as to why selling options is not inherently better is because of this little known event in the book that I mentioned at the beginning of this video, which is the Black Swan event. And what a Black Swan event is, for people who may not know, is a Black Swan event is anything that is not obviously predictable that may happen within a stock's price history. So for example, the coronavirus is a great example of a Black Swan event. It's something that quite literally no one could have predicted, right? There's no one who was in the market a year ago saying, oh my gosh, in 2020, there's going to be the coronavirus outbreak. It's impossible to predict when these things pop up, but when they do pop up, they cause a large move in the market. They cause increased volatility in the market, whether it be stocks crashing or stocks pumping, such as Zoom, and this increases the overall market volatility as it is a Black Swan event. And it doesn't just include these large economic events. There are also smaller economic events that are just as equally a Black Swan event. So let's say I'm trading Apple specifically. What can happen is, say there is a major lawsuit against Apple. Maybe a customer bought an iPhone and it exploded and it killed them, right? This is a major lawsuit for Apple, just a theoretical lawsuit. Now, the outcome of this lawsuit could be a very important factor for whether the stock price goes up or goes down, because if they lose this lawsuit, maybe they have to recall all the iPhones in the world, and that's going to be a huge loss for Apple. But if they win the lawsuit, then that is lifted off their shoulders and they don't have to worry about it anymore. So this is a black swan event that could pop out of nowhere that no one would be able to predict. Now, how does this relate to options buying and selling? The thing is, the main factor that a lot of people point to determine that options selling is more profitable than options buying is the fact that implied volatility tends to exceed the realized volatility in the market. And I'll have a little picture right here of some examples of markets where the implied volatility, which is the line on top, exceeds the realized volatility. I know this is going to sound very confusing if you're a little bit newer to options. Basically, what this means is options pricing are derived from the potential volatility of the market. So, for example, if I have an options position that expires in 1 week, the amount of time until that week is over is important, in addition to the market volatility within that period. Because if the market moves more, then there's a higher chance for the market to move through my strike price, either going away from it in the money or going farther from it out of the money. So that's just a quick lesson on how and why implied volatility matters. But you might be thinking with this chart here, since implied volatility tends to exceed realized volatility within the financial markets, then it's inherently more profitable to sell options. However, this is false, because what implied volatility is trying to predict is the potential amount that the market could move. And the thing about the potential amount that the market could move is that you need to take into account the potential for one of these black swan events. Because yes, there is the normal volatility that's going to be happening in a market. So if I'm trading a random stock, there's going to be some variance in the stock price throughout the day. But a black swan event is something that is very difficult to calculate. It's very difficult to get the percentage chance that there is going to be a global virus outbreak. And basically, the reason why the implied volatility tends to exceed the realized volatility for options positions is because traders are trying to account for the possibility that there is some crazy black swan event that people do not expect to happen, no matter when the option may expire. So if it's 1 day from the date that the option may expire, that's still in the price. If it's 1 week from when the option may expire, it's still in the price. It's always in the price of the option because it's something that's very important in order to calculate. Next, I want to go into this idea of if I have a higher win rate, then my strategy is more profitable. For example, if I have a strategy that makes money 70% of the time, but loses money 30% of the time, compared to another strategy that makes money 30% of the time and loses money 70% of the time, it's most likely that without any more information, you are just automatically going to pick the one that makes money 70% of the time. However, this can be a big flaw in how a lot of people think. The win rate of a strategy does not in fact correlate to the profitability of the strategy. If a strategy has a 70% win rate of $400 and a 30% rate of losing $1,000, then in fact, over time, your net profitability will be negative $20. And that can be done just simply by multiplying the percentage chance times the amount of money that you will be making or losing based on that trade. And so over time, if you have a strategy that is with those exact numbers that I just explained, then you will be losing $20 each time this occurs until you eventually lose all the money with your strategy. And this happens in the same way if you reverse the numbers. If you have a 30% chance of making $1,000 and a 70% chance of losing $400, over time your net gain is going to be positive $20. So even though you are losing more often than you're winning, you are still able to have a profitable strategy. And this is the exact same thing that happens with options trading. Although there is a technical lower probability for someone to make money by purchasing options, so for example, there's a lower chance of me buying a put than selling a put. There's a lower chance of me making money from buying that put than selling it. Although that is true, that does not take into account the potential profitability of either of those scenarios happening. The thing about purchasing options is that the profit potential is unlimited. So in the event of a Black Swan event, so in the event that there is a big court case against the company, or the drug gets approved by the FDA, or there is a coronavirus pandemic, in the event that something like that happens, then everyone who has been purchasing options will end up making a lot of money, and everyone who has been selling options will end up losing a lot of money. And although those people selling options might have made a little bit of money over time, a little bit, each and every trade, that one loss can wipe out all of the gains that they'd previously made by slowly selling options and making that profit. And then the person buying options, although he was slowly losing money over time, that one gain can exceed the losses that he had before. And so that's the logic behind buying or selling options. There is in fact no superior side. There is no bias towards buying or selling options because of the reasons that I just explained. And so what's the best way to think of options? I think a lot of people get stuck in this idea that buying is better or selling is better, when in reality, the way that you should look at it is think of options as an insurance contract. Imagine that I'm an insurance company. What I do as an insurance company is I sell insurance in order to try to make a profit, right? And insurance companies are able to be profitable because they price their insurance at a rate that will always be good for them. They will always end up making money in the long run. This is similar to what happens in options. However, imagine options as an insurance contract that is priced as well in the middle as it can be, right? The buyers and the sellers both have their self-interests. They're both trying to make money from buying or selling options. And the idea is, if you can have one extra piece of information, maybe you know that that court case has a higher probability of winning than people really think. Maybe if you know that extra piece of information, you can make that insurance contract slightly go in your favor and then allow you to become a long-term profitable trader. So the idea is, to recap this video, there's no better side to be on, whether it be buying or selling, and you should always structure your trades based on your own trading style and what you find suits you the best. Are you really good at determining when the market is going to be flat and avoiding Black Swan events? Or are you really good at predicting when possible Black Swan events can happen? And although you might be losing money in the short term, you're going to have one gain every month maybe that's going to make you a substantial amount of money that will exceed the losses that you would have otherwise had. Anyways, thank you all so much for watching this video. Hopefully you enjoyed, and see you in the next one.